Hello everybody, we are on. So let's go ahead and dive right into the homework. I believe we had covered kind of a wide variety of fixed asset, chapter 10 subjects last lecture. I think I gave you a couple quick studies, a couple exercises to do in regards to those. So let's go over those. I don't think those weren't too hard, were they? Not too bad? Okay. All right, well, let's take a look at quick study 10.5 real quick. Okay, quick study 10.5. All right. Now, I think we had to look back actually at quick study 10.3 to get some necessary information, didn't we? Okay. All right. Quick study 10.5 on page 421. Refer to the facts in Quick Study 10.3. Assume that the crossover band uses straight line depreciation, but realizes at the start of the second year, that due to concert bookings beyond expectations, this equipment will last only a total of 3 years. The salvage value remains unchanged. Compute the revised depreciation for both the second and the third year. Okay? All right, well, let's go back to Quick Study 10.3 a little bit and remind ourselves that the cost of this equipment was what? It was $55,900, is that correct? And what was the original salvage value? $1,900? And we were originally depreciating this over 4 years, is that correct? So we were depreciating $13,500 per year. Is that correct? Now we've only depreciated, this is the beginning of the second year that we make this change. So we've only depreciated 1 year, right? Okay. But what we want to do is calculate the book value at the point of revision. Well, let me just write this out for you. When we do revised depreciation, we have to take the book value at the date of revision minus the updated salvage value, if it's changed, over the remaining life. Is that correct? All right. So remember what book value is? What's book value? Cost minus accumulated depreciation. Okay? So the first thing we have to do is say, what's our book value at the date of revision for this asset? Well, like I said, we had depreciated only 1 year, and that amount was $13,500. So our book value at the date of depreciation, our book value at the point of revision, at the beginning of the second year, is $42,400. Correct? So what is our updated salvage value? Has that changed? No. It still is $1,900, right? So that's going to give us our numerator, and then we divide that by 2 years remaining. Okay? There's only 2 years left. We changed it to a total of 3 years, but there's only 2 years left since 1 year's gone by. And that means we're going to depreciate $20,250 for year 2 and for year 3. Each of those years will be $2,250. We're not going to go back and change year 1. Okay? We're just going to do this depreciation amount for each of the years, 2 and 3. Cool? All right, any questions on that? All right. Well, then let's go to the next one, which I believe was Quick Study 10.10. Quick Study 10.10. All right. Diamond Company acquires an ore mine at a cost of $1.3 billion. It incurs additional costs of $200,000 to access the mine, which is estimated to hold 500,000 tons of ore. The estimated value of the land after the ore is removed is $150,000. That's the salvage value. Okay. All right. First of all, they want us to prepare the entry to record the cost of the ore mine. Right? And how much is the cost of the ore mine in total? $1.5 million, right? $1.5 million. Let me get this down to where it should be. Okay. Okay. It should be $1.5 million, right? Because we have to include both the $1.3 million purchase price, but also the $200,000 to access the mine, which is a reasonable cost to get that fixed asset in operating condition, correct? So we debit ore mine, which is an asset, and we credit cash for $1.5 million, okay? Now the second thing that they want us to do is to prepare the year-end adjusting entry if 90,000 tons of ore are mined and sold the first year. Well, let's figure out how much we're going to deplete per unit first of all. We take the 1.5 million minus the salvage value divided by the total amount of tonnage that we think that mine contains, which is 500,000 tons. So we're going to each period depreciate $2.70 per ton. Now, the first year we extracted 90,000 tons times 270 equals an amount of 243,000 for the first year. Now remember, this is not depreciation expense, this is depletion expense. This is not accumulated depreciation, it's accumulated depletion. Okay? Because this is a natural resource, right? Depreciation has to do with fixed assets, depletion has to do with natural resources. Okay? All right, so any questions on that? Anybody? All right. Do you have a question, Sarah? We good? Okay. All right. Let's hop over to exercise 10.3. All right, this is a lump sum purchase, isn't it? And that was something that we talked about last lecture. Okay. Ming Yu Company pays $36,850 for real estate plus $19,600 in closing costs. The real estate consists of land appraised at $166,320. Let me start that sentence over. The real estate consists of land appraised at $166,320, land improvements appraised at $55,440, and a building appraised at $174,240. Allocate the total cost among the three purchased assets and prepare the journal entry to record the purchase. Okay? All right, the first thing we want to do is figure out what our total cost of acquisition was. Okay? We want to figure out what our total cost of acquisition is. And the total cost of acquisition is the purchase price plus those closing costs. Correct? So, what we got here is, I'm not doing a very good job operating this thing today. Okay? $387,850. Did you get that? Okay. So that's the total purchase price of it. Now, we want to utilize the appraised values to allocate, don't we? So, the appraised values for land improvements, and buildings are thus. Correct? Okay. Now, we're going to allocate those and get percents of total. 166,320 divided by 396,000 is 42%. 55,440 divided by 396,000 is 14%, etc. Did you have to round on these? Okay. If you have to round, that's fine, but you want to make sure these add up to 100%, right? Okay. Now then, what are we going to take that percent times? We're going to take it times that 387,850. Okay? And scoot this over a little bit. So we're going to take those percentages times 387,850. That's what they're doing here. And this gives us our apportioned cost. Correct? Once again, if it's a rounding issue, that's fine, but you have to make sure that your totals add up to the 387,850, because now what we're going to do is we're going to book a journal entry, okay? And you have to have your journal entry balance, don't you? Okay. All right. Does that make sense, folks?
By putting them all together like that, is that how you show that it was like one purchase? You're just breaking it up? Because I did separate ones.
You did a separate journal entry?
For each thing, yeah.
Yeah, so you did like debit land for 162,897.
Credit cash, debit
credit
building,
cash.
credit cash.
See, I probably wouldn't do that, because let me ask you this. If you look at your bank reconciliation and look at the cleared check, how much do you think the check was written for?
For the 387.
The check would be written for 387,850. Yeah. You didn't write 3 separate checks.
Right.
So it might foul you up on the reconciliation. Okay. All right. All right, cool. Any problems with that? All righty. Well, let's do the last one, which was exercise 10.9. All right, on April 1 of 2010, Stone Backhoe Company purchases a trencher for $250,000. The machine is expected to last 5 years and have a salvage value of $25,000. Compute depreciation expense for both 2010 and 2011, assuming the company uses the straight line method. All right, we can do that. Okay, I'm going to work this one out. Okay? All right, we're going to take, the way that I like to do this is I like to figure out how much would we depreciate if it were a full year. Okay? So, if it were a full year, we would take the cost of how much? $250,000? And what's the salvage value? And then what's the estimated life? 5 years. Okay, that means we would depreciate $45,000. In a full year. Okay? Now, in 2010, we don't have a full year, though, do we? How much of that year is this thing in operation? 9 months, because we bought it on what? April 1st. So that's April, May, June, July, August, September, October, November, December, 9 months. So we're going to take for 2010, 9/12 times $45,000. And that gives us $33,750. Okay, so that's how much there is for 2010. Now in 2011, we have it for a full year, don't we? In operations, correct? So we depreciate $45,000, or if you wanted to think about it, you could say, well, we had it for 12 out of 12 times $45,000. Of course, 12 divided by 12 is 1. So you could think of it that way if you would rather. Okay? Cool? That's not too hard, is it? Alrighty then. We are done. Probably just going to let you go a little early today. I'm just kidding. I'm not going to do that. Got you excited, though, didn't I? I love you too much to shortchange you. Okay? We're going to talk about some other... I think we're going to be able to wrap up chapter 10 today. So we will start chapter 11 next time. Okay? Start chapter 11. That's our last chapter. Okay, we're coming to the end. This is a good time for the class to start thinking of what sort of semester end gift that the students would like to present me with. Okay? In some countries and other cultures, these gifts can be rather extravagant. Okay? So, I mean, if everybody chipped in 30, 40 bucks, you can get me an iPad. That'd be pretty nice. I'd like one of those. Okay? So just start thinking about that amongst yourselves. Okay, we're going to start talking today about disposing of plant assets, okay? Now, just like human beings all will eventually die, I hope you guys knew that. I hope I'm not breaking that to you today, okay? All plant assets eventually are going to be disposed of, right? Plant assets don't last forever, right? Okay? Now, there's a number of ways that you can dispose of an asset. When we say dispose, we sometimes think about like just taking it out to the trash bin and throwing it in there. And that could certainly happen, okay? That's one way to dispose of an asset, is it's just broken and you throw it away. Or your car, if it's a car, maybe it breaks down and you just donate it to charity or take it to the junkyard, okay? But this is also for selling plant assets, right? If you sell your plant asset, okay? Now, another way that you can dispose of plant assets, we're not going to talk about too much, though, is what happens if you trade them in. Like if you trade in an old car on a new car. We're not going to get into that too much. We're mainly going to be talking about either just getting rid of them by throwing them away or by selling them, okay? All right, but there are 5 steps in disposing of plant assets. So let's take a look at these, okay? If you walk through these 5 steps, I think you're going to be okay, okay? All right, the first one is you want to update depreciation to the disposal date. So let's say you're disposing of an asset on May the 1st. Well, then you want to update depreciation and book that journal entry for those first 4 months of that year. You with me? Okay, so that's probably going to be a partial year depreciation entry, okay? Now, these next 4 steps have to do with creating the journal entry that you're going to book, okay? Let's see if I have my pointer today. Yep, I do, okay? So these steps right here have to do with building the journal entry, okay? We're going to remove the plant asset from the books. Then we're going to remove the related accumulated depreciation amount from the books. Then we're going to record any asset given or received. And if needed, we're going to either record a gain or a loss, okay, to balance the journal entry, okay? And I think this is going to be best illustrated with an example. Okay, so let's just do that. On September 30, 2011, Evans Company sells a machine that originally cost $100,000 and they sold it for $60,000 cash. The machine was placed in service on January 1 of 2008. It was depreciated using the straight line method, okay? And it had an estimated salvage value of $20,000 and a useful life of 10 years. Okay? All right, so I'm going to kind of work through this on the Elmo. All right? Somebody have their slides printed off? Can I use them? Because I'm going to have to switch over. Because I want to be able to access this info. Okay, thank you. Because once I switch over here, I can't see the other info. All right. So first of all, let's figure up how much they have been depreciating. Okay? Now, the original cost of the asset was, let me use the other marker. You can see it a little bit better. The original cost of the asset was $100,000. Is that correct? And what was the salvage value? Wasn't it $20,000? And what were we depreciating this over? 10 years? Is that correct? Yes. So what is the depreciation amount per year? 80,000 divided by 10. 8,000 per year. Is that correct? Is that right? Okay. So we bought this asset on January 1 of 2008. So we had it for a full year that first year. We don't have to do a partial year deal, right? So in 2008, we had depreciation of $8,000, correct? And in 2009, we also had depreciation of $8,000, correct? And in 2010, we had depreciation of $8,000. Are you with me? Okay. So now we have to go ahead and figure out depreciation for 2011. That's the first of the 5 steps, correct? Is to depreciate up to the date of disposal. And I think it says we're disposing of this on September 30th of 2011. So how many months depreciation is that? Huh? 9. So for 2011, we're going to take 9/12 times 8,000, which is what? 6,000? And we're going to go ahead and book that entry. We're going to make that journal entry in our books. So there's our journal entry that we would book. Okay? Correct? And so for 2011, we would have depreciation after we make this journal entry of $6,000. Correct? All right, any questions thus far? Okay. So what is our accumulated depreciation at the date of disposal on this asset? Our accumulated depreciation at 9/30 of 11 is 8 plus 8 plus 8 plus 6. What is that? 30? Okay. So to summarize, at 9/30 of 11, we have a cost of this asset of $100,000, and we have accumulated depreciation of $30,000. So that means our book value, which is cost minus accumulated depreciation, is $70,000. You with me? That's a 0. That looks a little weird, doesn't it? Okay. So that's where we are at this point right now. Okay? Questions? Okay, so now let's just make the journal entry. Well, what was the next step? What was the next step? Actually, the second step, the second, third, fourth, and fifth step are what we're going to do now in regards to those 5 steps. So the step that we need to do now is to remove the plant asset from the books. Correct? So the cost of that asset was $100,000, correct? So I think they said this was a machine. Is that correct? Is that right, guys? So we're going to credit machine for the cost, $100,000. This is the credit column. This is the debit column. All right? What's the next step that we have to do? Remove the accumulated depreciation from the books. And how much did we just say accumulated depreciation was? $30,000. Now, of course, let's step back here. Machine had a debit balance, so to take it off the books, we had to credit it, right? Accumulated depreciation has what type of balance? A credit, so we have to debit it to get it off the books. So let's debit accumulated depreciation for $30,000 to get it off the books. Okay? All right. The next step is to record any cash given or received in regards to disposing of this asset. Now, what did we sell it for? We sold it for $60,000 cash, didn't we? Okay. So that is cash being debited because it's being increased, correct? So that's our next step, is we debit cash for $60,000. Okay? Now the last step, our fifth step, is to see if the journal entry balances. It doesn't. So we either, if it's short on the debit side, we're going to record a loss. If it's short on the credit side, we're going to record a gain. Okay? Let's come off that PowerPoint, or come off that for a while. We haven't really talked about losses and gains, have we? Have we ever? Okay. A loss is kind of like an expense. It has a debit balance. It is on the income statement. Okay? It's almost like setting up a separate little expense account for a situation like this. Loss on sale of machine or whatever. Okay? So a loss has a debit balance like an expense. It's on the income statement. It's a temporary account. A gain is like a revenue. It has a credit balance. And it goes on the income statement. It's a temporary account as well. Okay? And it's kind of like a special little revenue account that we create for this sort of a situation if it were a gain. Does that make sense? So a loss is kind of like an expense. It has a debit balance. A gain is kind of like a revenue. It has a credit balance. Right? You with me? And they both go on the income statement and are either added or deducted in arriving at net income. Okay? So going back to this journal entry. Does this journal entry balance? No. Which side needs help? The debit side needs $10,000. So since we're debiting it, what are we going to call it? Is it a gain or loss? It's a loss. And we'll just say loss on disposal. And this amount would go on the income statement. That's our journal entry to record the disposal of this asset. All right? Okay. Okay, questions on that? Okay, let's see how they did it up here. Now another way to think about it is to just compare the book value of the asset. Whoops, let me get to there. To compare the book value of the asset with the amount that was received, okay, to see if there's a gain or a loss, okay. In this case, the book value was $70,000. We received $60,000. So there's a loss on $10,000. I kind of like the way I do it though, as far as building the journal entry. My feeling is you're going to have to make the journal entry anyway, and just use the conditions that journal entries have to balance. The total debits have to equal the total credits, just to kind of help you out here. Are you with me? So I like to think of it that way as opposed to in that purple box. If cash is greater than book value, record a gain, whatever. I just say book the journal entry, and the journal entry has to balance. Okay? All right. And then there's the journal entry for the disposal of the equipment. It's the same one we made, except that maybe a few things are in different order or something. Okay? Now, that one step was record any asset given or received for disposal of the asset, right? This step right here. Now let's talk about that, because somebody might say, why would you ever, I can understand how you might have an asset received when you dispose of an asset, like when we sold this machine, you have cash that's received, but why would you ever have to give an asset? Or specifically cash, why would you ever have to pay cash in disposing of an asset? Can you think of an example?
A tax write-off if you donate it or something?
Not so much a tax situation.
You have to transport it somewhere.
Yeah, you're getting close. I mean, think about it. Think about if the college was going to get rid of a small building, on the periphery of the campus. You're going to have to pay somebody to tear that thing down and haul it away, aren't you? Okay. Or there's certain types of computer equipment that you're not just supposed to throw computer monitors and electronics in the trash, are you? Environmentally, that's not very good. So sometimes there's the disposal fee on electronic equipment, right? You know what I'm saying? So let's say you have a bunch of computer monitors to throw away for a business to dispose of them. Well, you might actually have to pay cash of maybe like $5 or $10 each to dispose of those properly, which is kind of a bummer. But if you just toss them in the river or toss them in the trash because you don't want to pay your fee, there might be a newspaper story on you, and that's not going to reflect very well on your company, right? It's really bad for the environment to dump computer monitors or televisions in the trash. Okay, there's something chemically about the screens or something that's bad. Okay, same thing with oil, right? So can you see for a lot of different situations for a business now where they would actually have to pay some money to get rid of an asset properly? All right? Good. Okay, let's see how we're doing on time. What I want you to do, we're not going to have time to do the whole thing, but let's go ahead and do Quick Study 10.9, but just the first one. Number 1. There's 3 situations in Quick Study 10.9. Let's just do situation number 1 in Quick Study 10.9. Okay? I'll go ahead and read that to you real quick. Horizon Company owns equipment that cost $138,750 with accumulated depreciation of $81,000. So they've already done the first step. It's already depreciated up to that date. Okay? Horizon sells the equipment for cash. Record the sale of the equipment assuming Horizon sells the equipment for $63,000 cash. That's the part I want you to do. So let's just take about a minute and a half, 2 minutes for the music to play. You folks at home do it as well. We'll come back and go over the answer. All right? Okay, if you're not done at home, folks, just pause it and push play when you are done. Here is the journal entry for situation number 1. Okay. We, like I said, step 1 was already done for you. It was depreciated up to the date of disposal. So they removed the equipment by crediting it, right? Then they removed the accumulated depreciation by debiting it, since it has a credit balance. Then they recorded the cash that was received, $63,000, by debiting it, and it didn't balance, so we had to record a gain here, right? Okay, we had to balance this journal entry, we had to record a gain of $52.50. Or if you wanted to think of it a different way, you could compare the book value compared to what was received. Okay? Did you guys get that? Okay. Now, I told the people here in class, I'm talking to the folks at home now, I told the people here in class to go ahead, if they got done with number 1, and do this at the second and the third scenario as well. I'm going to go ahead and show the answer for that. But if you folks at home haven't done that, you might just want to pause this and do the second and third scenario and then check your answer. But here's the answer for the second and third scenario. Okay? All right? So take a look at that. In that second situation, we didn't need to balance the journal entry, did we? Because it was already balanced. There's no gain or loss recorded. And in the third situation, we had a loss. All right? Make sense? Okay. I like to ask you on the test sometimes what a gain or a loss is, because those are important types of accounts that you'll see in your business education and in your career. Remember, a loss is kind of like an expense account. It has a debit balance. It's on the income statement. A gain is kind of like a revenue. It has a credit balance, and it's also on the income statement. They're both temporary accounts, which means they're closed at the end of the period. Cool? All right, let's talk about the last few things in Chapter 10. And you can tell from your PowerPoints, I have skipped around a little bit, but hopefully it's not too hard to find where we're at. We're going to close it out now. We're going to start talking about intangible assets. Okay? So intangible assets. What are intangible assets? Well, what does intangible mean? Do y'all know? You can't touch it. Can't touch it. You can't feel it. Okay? They do not have physical substance, but they are long-term assets. A lot of times they provide like privileges or rights to the owner of them. Okay? Sometimes they're difficult in regards to determining what the useful life is. Okay? But they are used in our operations. Some examples are patents, copyrights, leaseholds, leasehold improvements, franchises and license, goodwill, trademark, and trade names. Okay? Now, your book talks about these. We're not going to go into great detail about them, but I'm going to hit on each one a little bit. Okay? A patent is when you have a right, the owner has a right to, like they invent something, and they have a right to sell and manufacture that for a period of time, usually 20 years. Okay? And what we do, now we had depreciation for fixed assets. We had depletion for natural resources. What we do with intangible assets is we have amortization. We amortize them. Thus, it's amortization expense and accumulated amortization. You with me? And you can read in your book about that. But let's look at an example. Let's say we purchased a patent for $10,000. Now, it has a useful life of 10 years. Okay, it's different than the 20. It has a useful life of 10 years. So, our journal entry to amortize, not to depreciate, not to deplete, but to amortize this patent would be $10,000 minus the salvage value of 0, divided by the 10 years would give us $1,000. You with me? But it's amortization expense as a debit and accumulated amortization as the credit. Cool? There's also something called copyrights, and you've maybe seen that symbol on like music or artistic work or something like that. Okay? That is gives the right of the publisher or the owner to sell it for usually 70 years. Or maybe it's, I guess, no, actually it's the life of the creator plus 70 years. Okay? So, you look befuddled.
I don't know. I just think the life of the creator plus like 70 years after they die.
Here's what that means. That means like take a Lady Gaga song, Poker Face. I'm assuming she wrote that song. Okay? Did she? Let's just say she did. Okay? Well, she has rights to that song for the rest of her life. Let's say she lives another 60 years. And then 70 years after that. Okay? So like Beethoven wrote Beethoven's Fifth Symphony, right? He has been dead and more than 70 years have passed. So that's no longer a copyrighted piece of work. Okay? Now this is not a law class. Okay? So we're not going to get real in depth to some of the other real legalese things as far as getting a copyright renewal or anything. Just want to kind of hit the surface of this. You'll talk about those other things in your law class. But that's what a copyright is. Okay? What about a leasehold or a leasehold improvement? A leasehold is like, let's say you have a lease on a strip mall because you're going to have a pizza shop in there or something like that, a pizza restaurant. Okay? Well, a leasehold is the right the lessor grants to you under the terms of the lease. And there's usually a determinable life, like 3 years or 4 years or whatever the lease is. Okay? When I had a business, we had an office lease. I think we signed a 3-year lease. Now, a leasehold improvement is if I want to do alterations or improvements to that little area in the building. I don't own it, but those are called leasehold improvements, such as like if I want to put up new walls or paint it or build a nice storefront or, you know what I'm saying? And what we do is we amortize those costs over the life of the lease. Okay? So let's say I spend a lot of money on like a nice new front door for my restaurant, for my pizza restaurant. Well, that door might last 5 years, but if the lease is only for 3 years, I would just amortize that over 3 years. Are you with me? You can read about that in your book. There's also things called franchises, right? Like let's say you have a dream of being a Subway sandwich shop owner. Well, you can pay a lot of money and get a franchise. Okay? You can get a franchise. And that's the rights granted by the company to be able to sell Subway sandwiches. Okay? There's also trademarks and trade names. Okay, these are kind of always interesting. But some examples would be like, here's some trademarks for BMW, NBC, and Lego. Right? Those are trademarked. Okay? Those are intangible assets to those companies. And you can't use those. Those aren't your assets, right? Okay? McDonald's has the big golden arches, right? Well, when I was in high school, a donut shop opened up, and this donut shop had no affiliation with McDonald's, and they tried to call their donut shop McDonut, and they had the M written that way. Well, they got a very nice letter from the lawyer that said, you're not going to do this, okay? Because that M is trademarked, and actually, in a lot of situations, the MC is trademarked. So they couldn't even say McDonut, okay? So they had to change their name, okay? There's also, going back to the PowerPoints, there's phrases or jingles, like just do it, or I'm loving it. Those are copyrighted, or I'm sorry, those are trademarks or trade names affiliated with Nike and with McDonald's, respectively, right? You ever heard that boxing guy that goes, let's get ready to rumble, right? He has that trademarked. And you know how much he makes every time he says that? Tens of thousands of dollars. He shows up in his tuxedo, he says that phrase, and he gets paid more than I make in a year. That doesn't seem fair, does it? Okay? Now, if I wanted to start my own business and say, I'll come out, Dave Krug will come out, I have a pretty good voice, and I'll say, let's get ready to rumble, I'd get sued really quickly. Okay? Because, I think his name's Michael Buffer. He has that trademark. Okay? I should think of my own catchphrase, right? Debits on the left, credits on the right. Okay? I could say it in front of before tests at schools. All right?
I have a question.
Yeah.
How do you figure out what the amount of the asset is for something like that?
That's a great question. That's a great question. For some of these, okay, first of all, it depends. If you purchase it from somebody else who developed it, then that's easier, isn't it? But like if you have a advertising company or some sort of creative agency that creates it for you, then you purchase it for whatever you paid for them to do it. If you develop it internally, sometimes it's harder. You have to think of the costs associated with it. That's a very good question. It's a very advanced accounting subject. But just know this. Know that there's a costs associated with getting these things, either by having somebody else do it and paying them for those services, or by having your own people do it and paying them. And those are the sort of costs that would be capitalized.
Okay, so it's just the cost is the amount of the asset. Okay.
Yeah. And again, I mean, I'm saying yes, but I'm going to put a little asterisk by it. This can be a very, very complicated area of accounting. One thing we're not going to talk about in this class is goodwill. You can read about it in your book. Goodwill can be a very abused, very complicated part of a balance sheet. And I've gone out to some of my clients who have really used goodwill, intangible assets, to try to do some weird things on their financial statements. So some of these I'm just going to touch on, okay? Good question, though. All right, the last thing I want to talk about, and you can read about this in your book, is total asset turnover, okay? Total asset turnovers is how efficient are we using our assets in generating sales. And read about this a little further, but you take your net sales divided by your average total assets. Some companies have a lot of assets to generate sales, don't they? Like think of an automobile plant, or Coors, or Anheuser-Busch, which are listed. I mean, they have a lot of fixed assets, don't they? They have a lot of assets, okay? There's other companies that actually don't have that many assets. Maybe not fixed assets, and maybe because of that, not many total assets, like a consulting company. All right? So you want to make sure when you're calculating asset turnover, we always say this with these ratios, you have to compare it to similar companies, or to the industry, or to your own company in prior periods. But read about the total asset turnover in regards to how efficient a company is using its assets in your book. And that is the end of chapter 10. Let me give you your homework. One of these I crossed out because we ended up doing in class. So the only homework you have to do for next time is right there up on the screen. And we will start chapter 11 next time, our last chapter, all right? So once you get that homework copy down, you can go on your merry way. We'll see you guys. Bye-bye.